My name is Bahay Ozcakmak, Group Managing Director and CEO of Parkway Corporate Limited, listed on the ASX, and we are an industrial water treatment company.
Bahay, thanks for joining us. I like this one. I'm interested in this kind of services industry around mining and industrials. I think we're going to learn a thing or two today, I suspect, having done my homework. Tell us a little bit about you. What's your background?
So I have a science commerce background, MBA, been focused on energy and resources technologies for a long time. So worked in commercializing technologies to improve the sustainability and efficiency of a range of technologies. And in this case, very much focused on the water industry.
Right. Okay. And how long have you guys been going in this?
So Parkway's been listed for about 10 years. We were initially a mineral exploration company focused on fertilizer minerals. And I joined the company 2.5 years ago and really taken the company in a different direction, Matt. So I joined 2.5 years ago, and now we're very much transitioning to sort of mining technologies, and particularly the water element, so in terms of water and wastewater generated from energy mining.
Right, and what at that time led you to believe that that would be the right move? Obviously, today we're seeing a lot of chat around, EV revolutions and the kind of green thematics and, carbon credits. And, it's very much today of the moment. But 2.5 years ago, what led you to go down this track?
Always been interested in sustainability. So some of those sectors I'd worked in previously always had a sustainability angle. And I think it was very clear to see water's been very problematic for a long time. So in Australia at the time, of completing my undergraduate studies, sort of around 2000, there was a millennial drought in Australia. So we had environmentalists talking about it never raining again, and all very dramatic. So it really was the topic of the moment. So always had a passionate interest in it, and it was very clear to me, sort of about 5 to 6 years ago, that a lot of these challenges, trying to get new copper projects permitted, for example, or some of these tailings related sort of challenges that, both on the raw water side or getting access to, feed water, and then also on the waste side, that this was only going to be an issue that was going to just get, more and more complicated. And I think whilst, the ESG concerns are very significant, I think this sort of it's a clear business risk. If you look at the KPMG or EY sort of studies every year, surveys asking the miners, what are the biggest risks you see to the viability of operations? It's very much, access to water, and or broader ESG-related risks.
Right. So let's look at the actual products, because going through your presentations, you've gone through a process of productizing them, kind of make it, veering towards a technology company, right? It's innovative water solutions as a solution to these different industries, which we'll talk about in a second. So why have you tried to paint the picture or write the narrative like that? Why is this going to be a technology company? Why is it not just a regular water services company?
Yeah, for sure. So a key part of our business is this technology. So we provide conventional water treatment. So processes people may be familiar with, reverse osmosis, they're all very important, almost commoditized sort of solutions. So we are increasingly delivering those solutions as well. That's really a stepping stone. They're low margin, very difficult to differentiate yourself. And we're very much focused on our own proprietary technology. So I actually joined the company by backing in a private company I founded. We'd spent nearly $10 million over 10 years incubating these technologies. And we've actually subsequently acquired a few more technologies. So for us, we're interested in delivering new technologies. But the reason we're sort of framing this as a technology as a service, if you will, getting new technologies is very complicated. Getting new technologies commercialized is very complicated. Being able to convince large risk-averse companies to take on something new is inherently challenging. So what we've sought to do from the beginning is align ourselves with a leading research organisation, Victoria University, that is well recognised in this area of industrial water treatment. And similarly, we partnered with Worley several years ago, a global engineering company that's well recognised. So what we've done is developed a capability, if you will, where we can take these technologies, validate, pilot, and then deliver a solution, as opposed to coming across as just a university R&D outfit. This is very much sort of an industrialized commercialization capability we've developed.
Right. In layman's terms, because we could get quite sciencey and lose a few people here, and get quite technical and lose a few people here. Most people will go water treatment, its broadest description. It's very simple. You're talking about multiple applications from multiple industries and companies. So in terms of what you do, in terms of the treatment from, I say there's a kind of very commoditized view of what it involves. But for you guys, you're saying you're creating technologies and solutions fit for purpose. So what's the range of solutions that you're offering here?
So we offer a very broad range of solutions, and part of the reason is in order to be able to implement our particular special sauce, if you will, that often requires pre-treatment or the application of other technologies as well. So we made the decision 18 months ago, rather than collaborate potentially with competitors, what we should do is, since these are low-cost, well-understood technologies, we should, we should develop those capabilities ourselves and provide more of a one-stop shop, if you will, in cases where we can apply our own technology. And I guess the one important point I think worth making, Matt, is in relation to our technology, we're very much focused on applications where there's a recoverable product, so beneficial retreatments, reprocessing, if you will. So in a case where there's a tailings dam or an industrial waste stream, often we're not interested in just providing a technical solution. Often these things aren't viable to treat. So we're very much focused on mining the waste, if you will.
Right. So, but maybe it might be worth getting in some examples and some use cases where, sure. because I think it's important to actually understand, okay, here's what you do. This is the cost to you. Cost of winning a deal, the cost of and margins involved in those deals, and how do you kind of scale those deals? Because if it's a very people intensive process, margins tend to be lower, and the number of deals that you transactions that you do, how do you get that scale? I'm kind of intrigued.
Yeah, so you're right, there is a whole spectrum of opportunities. So when you're dealing with a lower margin, easy to sell product solution, it's very easy to target projects in the sub $100,000 range. And whilst we're developing capabilities in that area, we have a team of engineers, technical people, so it's easy for us to service those industries. But that's not our primary focus. That's more opportunistic. For instance, if it's a major mining company, we wish to build a relationship, we might take on that sort of work. But our target market really is, on the tech part of our business, nothing we're involved with is less than a $20 million project. These are large transformational projects. They're highly complex and they have long lead times. And perhaps just to outline the value proposition here, for instance, a typical application may be a refinery. So it may be processing some sort of, copper, nickel, or it's going through and producing some sort of waste that may contain some residual nickel sulfate, cobalt sulfate, ammonium sulfate, whatever it happens to be, after it's been stripped. And that then goes and sits in some sort of tailing storage type facility. So there's all sorts of costs associated with storing that waste in terms of retreatment, in terms of monitoring. So some of our technologies enable us to treat those waste streams and recover additional reagents and chemicals and saleable products from that waste stream. So the cost may be $2, $5, $10, $20 per cubic meter to treat that waste. But the value we generate isn't just the processing or the treatment, if you will. There's saleable products which almost always exceed the cost of processing. They're the sorts of projects we're most interested in.
Okay, hang on. You said it's a $20 million project. $20 million in what fees to you? $20 million of total fees, but not all attributed to you? I mean, because I'm looking at your PowerPoint. You said you've got $1 million quarterly sales, right? You're a, whatever, let's say $30 million Aussie company. So I'm just intrigued as to the, how you identify which services you can sell, which have a significant benefit to the person that's buying it from you, where you can, in a very meaningful way, say the cost becomes insignificant. It becomes disconnected with the amount of time spent on it. And it's more about the benefit that you're delivering to that customer. So again, talk to me how you focus your business and what are those key products given where you're at today.
Yeah, no, absolutely. So I guess the initial number I referenced may have been a capex number, for instance. So given these are, and essentially, we talk about water treatment, but in many ways these are hydrometallurgical sort of chemical plants. So they are relatively large. And if we're going to spend, as you're alluding to, the time to do the business development work and incubate these projects, you want to solve problems that are big enough to be, move the needle for a public company, essentially. So we've made reference to several projects that would deliver a net benefit to the customer, not necessarily cash flow to us, but net benefit to a customer in the order of $50 to $100 million a year. So these are very significant projects, and they're complicated projects, which sort of explains the gestation period. But I think early this year, a month or so ago, we actually announced that we'd done a deal with Shell, and I think that project sort of provides a little bit of insight into the types of partners, the scale of projects, and the sorts of business model. And if you like, I can sort of go into some of those metrics, which will give you a good sense of what we're building here. So essentially, we announced about a month or so ago that we were awarded a feasibility study by Shell, and without sort of going into the backstory of, we'd been in collaboration for nearly 2 years. So that's quite a long process to be able to perform various piloting studies, internal evaluations, to really demonstrate that we can deliver a solution for the customer. For that particular project, Shell operates a series of gas fields in Queensland, Australia. They produce 8 million tonnes a year of LNG. But part of the process involves they have to dewater coal seams, and that process generates an enormous amount of wastewater. And the industry as a whole has spent more than $100 million over the last decade trying to develop a solution for this wastewater. So it's something that's been well understood. We have a technology we acquired a number of years ago. We've performed some piloting studies, and we're able to demonstrate that we have a solution for this problem, essentially. So we came out in early April, and we sort of quantified this market, knowing that we were going to sort of announce a feasibility study. We wanted to provide the market with some metrics around the size. What's the addressable market here? And using our sort of internal estimates, we sort of calculated the size of that market is worth something like $300 million a year to treat the wastewater generated from this one industry in Australia. And essentially the largest player in that market is Shell. So we've got this enormous addressable market. We have the dominant market player in Shell, and they've awarded us a feasibility study to be able to take that waste stream and demonstrate that we could build a plant to essentially come up with a long-term solution. And the value proposition is derived by, in our case, we can take this waste, we can treat it and produce saleable products. So all the waste ends up in product. It ends up in a lime product, a salt product, and a caustic product, all of which can be sold and generate revenue. But the real value is actually in the fact that you don't have to dispose of that waste. So this is regulated waste. You have to pay a levy to dispose of that waste, and the industry is highly regulated. So this is really a enormous captive opportunity for a company the size of Parkway, and it's an example of a large project, credible partner, highly complex. And our business model as the technology solution provider, we wouldn't necessarily build or own that plant ourselves. There are infrastructure type sort of investors that would be natural owners of these sorts of plants, whether they're industry players or whether they're sort of special purpose type sort of vehicles. But we as the solution provider would capture a share of that value that's created. And without sort of putting too many metrics, these projects are in the order of, in excess of $100 million a year, sort of net benefit. If you take away the current cost associated with managing that liability and you net off all the costs and add the revenue from the product sales, they're the sorts of numbers we're talking about. So to be able to capture a 5, 10, 20% share of that value is, in our view, is thoroughly, realistic expectation.
Well, it is if you throw 5, 10, or 20% at it. But what's the reality of this? Because you're going and you talk about providing a service as a consultant, and consultancies generally tend to, that's not a fantastic business model for growth unless you hire more consultants. So how do you have the conversation with these industry partners and say, do you know what, we are going to net off for you an extra 20, 50, 100 million a year. We'd like a percentage of that. That's going to be a new model for them, right? In the technology space, you kind of see it a bit. You are moving to a sort of technology type setup, but they're not going to be used to those sorts of conversations. So have you had much joy in terms of saying, don't worry about monthly retainer or fees, we'll take a percentage of the upside, or maybe a combination of both? Or is it early days?
No, we're quite the way down that path. So I guess a couple of distinctions to make. So we're most certainly not just a service provider. So we're a solution provider. This is technology that is patented. It's technology we've developed over a very long period of time. And quite frankly, there's no other solution. So if the client wishes to capture this benefit over here that we're demonstrated to them works on scale, third-party reviewed, and they wish to take, a benefit from that $50 or $100 million in savings, then they'll need to engage us and our partners to help deliver a solution. And the terms of that, we will obviously negotiate in good faith. But that's, I think, quite a powerful negotiating position.
Explain the difference to me. That it is. So, but explain it for people who may not be au fait with it, because you can trademark and register and patent whatever you want. But the bit that you said that was interesting, like no one else can do this. You're saying you're a market of one. So the option for the market is one. So there's a scarcity value to that. So you're saying there's no competition for you. Is that what you're saying?
So in certain markets, there are alternatives, but we're deliberately, you may have seen in our recent presentation, tackling projects that are complicated. And if there is an easy, low-cost solution, we would encourage them to go use that. We would try and offer that ourselves. So we're only going down this path where the pain is so significant, these problems are so important to solve, that we're investing time and energy. And part of that is we expect, appropriate sort of, recognition of the value we bring. And for those who aren't familiar, this sort of business model isn't actually unique in industrial sort of technology. So for people unfamiliar with the sector, for instance, several years ago, we entered into a global strategic partnership with Worley. And they routinely deliver technology-based solutions to industry. Their business is the energy, chemical and resources. So an ideal partner for us. We have a global partnership with them. And that's part of their business model. So they've transitioned from lump sum turnkey type sort of projects to why don't we deliver a little incremental CapEx project, save you costs, reduce your emissions, and the value you save, we will capture a share of that. So they've actually assisted and guided us in bringing, real domain expertise in developing these, business models. And in terms of the final part of your question, is there any pushback from our clients? So we're going to give you guys a share of what we're making. The only pushback we've had is they don't like the word royalty. They prefer if it was called a tolling fee. That's the extent of the negative feedback we have. So keeping in mind, this is value that they cannot capture without us. This isn't value. This isn't an overriding royalty on a streaming deal. This is revenue and savings we're generating for them only because we're working together with them. So
no, that's why I used the word net earlier, because I think it's an important distinction. Okay, so you mentioned 300 million earlier in terms of this industry for this solution. Look, I keep coming back to quarterly sales of $1 million, right? Sub $30 million company, and I want to see how this thing moves from the theory or the setting up phase, as it were. You're setting yourself up for success or best chance of success, through to how do you drive the revenue? How does the revenue curve accelerate forward? Because otherwise, share price ain't going to move because people are saying, well, there's no growth component to this story. So what's it look like?
Yeah, I guess it's all relative. I mean, just looking backwards, I guess sort of 12 months ago, we had a number of technologies, building out a team, and zero revenue. So in terms of rapidly ramping up to $1 million in sales in the last quarter, a feasibility study that our client is paying us $600,000 to do, to a growing pipeline of opportunities. I think that's, relatively speaking, a big step up in sort of activity. And moving forward, I think as these projects advance, in my view, given how material these projects are, a project that could be netting you, $10-20 million a year in earnings, not in revenue, being able to apply any sort of discount factor or multiple to that, I think the market would, I don't want to sort of speculate on how the market would reward that, but I think that's quite attractive, having sort of been involved in a few sort of, I know the North American market, for instance, is particularly keen on sort of royalty markets. They like that sort of upside exposure without necessarily being exposed to capex and cost overruns. So I think there's a lot to like there. And then in the meantime, the more conventional water treatment part of our business, we've got visibility on getting that to the point where, it'd be inappropriate to make financial forecasts, but we've got visibility in the near term, that business being able to, carry the group essentially. So if this is a self-funding sort of tech company, as opposed to, chasing rainbows and every 6 months doing a dilutive sort of capital raising. And not to put too fine a point, I'm the largest individual shareholder of the company. I own 10% of the company. So we haven't raised raised any funds in the last 18 months. And if you look at our last quarterly burn, whilst $1 million in revenue doesn't sound like a lot, our net burn for 3 months of operations, for 3 locations, 30 staff was, $300,000-400,000. And I think, in public company land, that's a lot of bang for buck, I think. Yeah.
It is. And to be commended, right? But I got to focus on this growth thing again, because I want to know, do I put money into this because we're at a stepping point for the business, right? You go where others fear to tread. I get it. The kind of conventional commoditized part of the business can, sustain you in terms of revenue. That's fine. But I want to see how you go after the market, how you drive this revenue component, please. So if and sorry to bang on about it. It's so important, I think, for me to kind of get my head around where this thing is going, to sort of see the ambition for the company. So you've given us kind of a case study there, which could be 5-20 million a year of income. It's harder to sell to big companies. They take longer to make decisions, and they take longer to make decisions because they need to know that you're not going to let them down, because the knock-on effect for them could be significant if you get things wrong, if your technology doesn't work. So there's a long lead time, right? So, but maybe once you're in bed with them, it's a little bit easier. So what does this ramp-up period look like? What are the other sectors, or what are the other organizations that you're looking to get into bed with, and what is the conversion time frame? Sure.
Yeah, no, great question. So it's something we try and sort of maintain a bit of balance in the portfolio, but perhaps I could just walk you through a generic sales cycle, if you like, from initial opportunity through to perhaps an operating project. So we have significant sort of inbound inquiries and a great network within the company, sort of organic sort of relationships around known problems that are complicated, and we're very efficient at being able to screen these things. They have to be large enough, compatible with our technologies, creditworthy partners. All these things are very important to us. There's no point chasing projects that are immaterial or can't be financed. So we're very ruthless in that regard. We then go through a series of de-risking exercise. So initially desktop, is there enough recoverable value here for us to throw into our very limited bandwidth? There's only a certain number of projects we can work on. And that's all, sort of a couple of months perhaps. And if the project has legs, we'll then often proceed to a small scale, bench scale piloting. Send us a small sample. Let's get a proof of concept. We can actually treat this as an initial. What we're trying to do is show that our technology doesn't work at that point, so we can pull the plug. So if the project still stacks up, we then need to spend some serious time on the project. So we'll prepare a proposal for the client. That could be like a scoping study. It could be like a pre-feas type study. And the costs are associated. That could be a couple of $100,000, 3 to 6 months worth of work, where we essentially do some technology de-risking type work. And from there, we then enter into full fees. So the first technology project that we've taken that full cycle through to a full feasibility study, which essentially leads to FID, is the Shell project that was awarded a month or so ago. And that's a roughly 9-month process that's supported by our partners I listed earlier, Victoria University and Worley. And when we get to that stage, we then enter some sort of, commercial delivery model, and our colleagues at Worley would transition from assisting us with the study to being a technology delivery partner. So, and depending on what the model there is, we would then seek to deliver the project. And I guess what's very important to us, we're sort of starting off with the end in mind. So often we're thinking, if this is a problem that's so problematic for Shell, would they be interested in ultimately building and owning or at least financing such a initiative, and what might that be worth? So we haven't provided any guidance on that, but for a project of this type, subject to FID, it would typically be something like an 18-month turnaround to build something, commission something, and then at that stage we would have some sort of KPIs that would enable us to essentially share in the value being created there. Not to sort of dwell on that one example, but it's sort of one of the more public, we've provided some detail on that publicly, but I guess one thing to keep in mind is that's an industry-wide solution potentially. So being able to deliver a solution for one customer means that conceivably this should be adopted by all the other players in the industry that are facing a similar challenge. Okay,
it is a good example. It's a big example. That's the QGC deal you're referring to there. You've got, what is it? They're paying you what, $600 in fees, and there was nothing in the news release that talked about the potential upside component that I noted. Maybe I missed it, but is there documentation of the potential upside? Because it gives an indication to the market that, oh, this is how these guys could structure it. Oh, this is the potential upside. You just need one, don't you? You need one example out there.
Well, that's right. I mean, interestingly, actually, Shell actually asked us at this concurrently to be negotiating a term sheet. So the idea on how this project might be delivered. So that's very much sort of without sort of divulging too many confidences. We had a project meeting yesterday with them, and we sat down and we developed a charter for how this project would be delivered under one team. So this is not a desktop exercise where they've thrown, a loose change to investigate and go down some rabbit holes. This is very much contemplated as subject to attractive results from feasibility. There is no alternative. We will work with you and your partners to find a way to deliver this project. And, with a team of experienced engineers, that's, very uplifting for the team that, this thing has legs. And I guess there's other similar opportunities that we're working on that are similarly disruptive. That if they get to a stage where they get built, they will generate hundreds of millions of dollars worth of value. And I guess the challenge there is, if these were easy, everybody would do them. So I guess we just have to be methodical in our approach and de-risk them systematically. And I guess at the beginning of the call, you sort of outlined, about the company and the team, and it's maybe just a good time to sort of introduce. So when I became the managing director, the first thing I did is I built a team of experienced process engineers from major companies, Worley, Jacobs, who held principal engineering roles. So these guys are not intimidated by, $50, $100, $200 million projects, dealing with, engineering contractors, dealing with, a whole range of stakeholders necessary to get these projects off the ground. So we understand the challenge, we understand the clients, we have the capabilities to take these projects through to feasibility study. And when we transition to a delivery phase, we're partnered with a global engineering company the whole way who can take the lead on that. So it's a very deliberate, I think, a methodical approach. And that's what I think's convinced the likes of, Shell that, they didn't award the feasibility study to Worley, they awarded it to us. So we've had to become an approved vendor. We went through ISO accreditation. You can imagine the due diligence required to be able to, be awarded that.
We've done the research on the team. It's a good, strong team. I haven't dug into the products because, I understand that they work, and I understand how you positioned it. I'm just, when I see situations like this, and it's all about the sales, right? And the way you structure the sales and the way you get remunerated, and big companies work a specific way. You said something interesting there, which was that you're going through a process with Shell or through QGC, owned by predominantly by Shell, to show that this thing works and that there's a net benefit to the company, because they want to see that, you want to see that. And this isn't, you said, it's not just another one of these, let's sort of have a look at it. And we're looking at lots of other similar companies in the same way, and we'll pick one at the end of it. You're saying you're the only one that can do for them what they need to do. So I mentioned that need. What problem are they solving? Where's the pressure coming from for them to do this? Because these big companies don't tend to kind of get distracted on small projects. They must believe it could potentially be important. So where's that pressure coming from on them to deliver the solution in the way that you can?
Yeah, for sure. So I guess there's a couple of components to that. So the starting point is there's over the life of these projects that have already been sanctioned, so there's roughly a 20-year remaining life, those projects will generate enough wastewater that will contain 5.5 million tonnes of salt that will need to be disposed of in Queensland. And the current business as usual scenario involves developing specially lined disposal facilities, crystallizing the brine to produce salts, and building that to a capacity where it can be maintained safely for more than 150 years. And after you've spent all that time and effort, you will then have to pay the government $170 per tonne, not to dispose of it, just as a levy, because what you're essentially doing is leaving the state with a liability. That's the base case at the moment. And part of their permitting conditions explicitly, this is all public information, states that if there is any form of beneficial reuse of this wastewater, you are obligated as part of your licensing conditions to go and evaluate those options. So in this particular case, not to sort of make it sort of sound like an ultimatum, I would suggest that, if it's good enough for Shell to engage us to go and evaluate the feasibility of this option, of this technology, it would be incumbent on others to, perhaps consider their options as well. So that's the backdrop against the liability, and that's all public information. And the opportunity for Parkway and Shell, quite frankly, is to be able to demonstrate that we are a globally responsible company. We understand our liabilities and the obligations we have to treat our waste streams sustainably. And here we are investing in new technology to essentially invest in the circular economy, convert these liabilities and wastes into beneficial products. And some of those sorts of details that may emerge sort of in coming months is, potential off-takers for these products, for example, the potential site for this location. So there's actually a site identified near infrastructure that, would make sense to convert all these liabilities, treat them, produce products and sell them into domestic markets. So it really is a transformation from a horrible environmental legacy to something that really, generates economic activity and is actually, earnings accretive. This isn't, spending money to just deal with your waste. This is very much an earnings accretive proposition we're putting to them.
Okay, that's interesting. It gives a kind of economic backdrop to that. With regards to the contract, I saw in the release it was the feasibility studies for 12 months, right? So again, you say you're having your current conversations about what remuneration packages could look like going forward, and I know you're not at the point where you can disclose that, and it may be terms of the agreement that you can't ever, but that's the kind of bit that the market would be looking for from the company, because if the contracts are kind of short term, how long or how much of an annuity stream of cash can you get from projects like this ongoing would be a kind of question that I'd be keen to understand.
Yeah, for sure. So there's really a whole spectrum. I mean, we worked on a project relatively recently for a mining company, actually similar scale. So I don't want to draw too many parallels, but we got a bit more information there. For that particular project, we produced a byproduct that I probably shouldn't disclose, but the mining company was reluctant that byproduct isn't their core business. So the issue for them was, we're not the natural owner of one of these water treatment plants, even though it makes great economic sense. So we actually explored a number of options. Does it make sense for a third party, for instance, to own and operate this, industrial infrastructure, if you will? And we actually entered into a, collaboration with let's call them some sort of diversified water treatment company that, is much larger than we are. And they have the capacity to potentially own and operate one of these plants. And we would simply be the technology solution provider. And the sorts of numbers that we're talking about in that scenario, the number we quote publicly is 5 to 20%, but I guess it's important to sort of what does that apply to? And it's essentially, it's a non-IFRS measure, but it's essentially, in our view, the net benefit. If we net off all the costs of capital and the foregone costs, what does that sort of sum of those parts look like? And for us to capture a share of that. Importantly, though, I guess we can only have these discussions if we have a technology that's very unique. If it's a commoditized solution, of course, the customer just wants to pay you for your goods and send you packing, and they're not opportunities we're interested in. No.
Okay. So, and have you given guidance to the market about, again, what you think's coming down the line? Is it hard to talk about? Because with software, I guess, and long lead times, etc., and the number of conversations going, it's hard to kind of give guidance on revenue. But do you think you'll kind of get to a point where you can start talking to the market about what your expectations are?
Well, for sure. I mean, you're right. I mean, we're only a very small company. We're capped at $25 million. But I guess as these projects become increasingly significant, I mean, for a small company our size, $1 or $2 million project award, sort of moves the needle. So under ASX continuous disclosure, we'd of course have to make those disclosures. But I think over the next 6 to 12 months, I think it'll be a very significant uptick in activity and in terms of being able to disclose material news. So the last sort of going back, I mentioned I joined the company 2.5 years ago. At the time, I was the only employee here. So there was a whole lot of capability development, building a team around me, making it sort of acquisitions, recapitalizing the company. So, that's quite a process during COVID, but we're really at the stage now where we have operating divisions, operating teams, own technologies, ongoing studies. So I think we'll be able to have more confidence in being able to come out and provide some guidance. The difficulty with guidance, of course, is these are lumpy projects. These aren't sort of 20 projects worth 100,000 that if you won a couple more or lost a couple, it wouldn't matter. I mean, these are projects where, you're working with a Fortune 500 company that may pay $2 million to do something, to work on a $100 million project. I mean, you're either going to get it or you're not going to get it, makes it a bit difficult sometimes.
Yes. Fairly binary in that sense. Because, you can do the more complex stuff, and maybe the companies don't necessarily want to go down that track. I guess they do have options in a sense. Maybe not the best solution, but a solution. How do you you're sort of productizing some of the services and the technologies that you've got, but do you think they're at a point where you can license them? Because again, in terms of scale, that may give you options, but is that something that you're looking at, have looked at and discounted? And where are you at?
Yeah, so from a scalability and ramp up sort of perspective, I see where the question's coming from, and I think it's a great question in terms of what's going to constrain us, being able to roll this sort of out. So I think great question. We very deliberately structured this agreement with Worley at the beginning, when we sort of first embarked on this journey, and that's a great relationship. And what that does is it basically debottlenecks the execution phase here. So the idea that we need to sort of go partner with other people to help us deliver isn't actually a natural constraint. Our constraint is being able to take projects. The bottleneck for us is there are more inquiries than we could possibly handle many times over. So we have to screen them as ruthlessly as we can and really work on projects where it's a large project. The client has no other alternative. They literally have to tell us that they've gone through exhausted options, and they have to be able to throw money at it to really solve the problem. And if we're at that point, we take it through this sort of internal evaluation stage. But any of those projects that reach FID, let's say the Shell project in 9 months reaches a successful completion of the feasibility study, the board of Shell reviews that, they decide to proceed with that. There is no inherent constraint at that point in being able to deliver that project. Companies like Worley deliver far larger and more complex projects all over the world routinely. So I don't think we'll go down the licensing part. There are some IP sort of challenges and developed IP that I've been involved in the past with other technologies that, quite frankly, would rather not go there yet.
Yeah, that gets a bit messy. It gets a bit messy. Hey, well, I enjoyed that. I learned a lot, which is always good fun. Look, would love you to kind of stay in touch with us as things progress. Certainly with the with the Shell project, and good luck with that. And we will definitely look forward to hearing from you again.
Yeah, appreciate the opportunity. Thanks for the questions, Matt.